Next up, we have Wes from Glasshouse Research. And let me see if I can get him. Now, Wes does not want to be have his video, which we are honoring, but he is screen sharing. And Wes, is your audio on?
Yes.
Okay, great. So I'll just give it over to you.
And so you can see my screen right now. And well, let me present.
I can see your screen. If you want to go into presentation mode, it might be even. That's it. There you go. Okay, cool. I'll let you take it away here. Thanks.
Awesome. Thanks so much. All right, we're excited to be here today presenting. This is our 10th campaign. However, this is the first time we're presenting, in a virtual conference. We're really excited about that. Our target company today is Columbia Sportswear, ticker COLM, title Columbia Sportswear, headed for a rocky fall, Under Armour Part 2. So we draw a lot of parallels from Columbia to Under Armour. Obviously, Under Armour last year ran into some issues with the SEC in terms of revenue recognition. And we see a lot of those same kind of red flags come up with Columbia Sportswear, if not more. This is our second report for the year, most likely our last, and it's without a doubt our highest conviction name for the year. We'll publish our full 39-page report on our website subsequent to this call. If you like our work today, we ask that you please subscribe and follow us on Twitter. So cool. Before we jump into it, who is Glasshouse? We're kind of a decentralized team all across the country, forensic accountants, analysts, work for hedge funds, boutique forensic accounting firms. But we kind of posted the names we've written on previously, and we are definitely proud of our work. We know a lot of other short sellers may have had, up 100%, 200%, 300% names. I mean, we call that getting your face ripped off in the business. We haven't had that happen to us, so we are very selective with the names we pick. We pride ourselves on not writing on too many names per year. It's interesting, we keep hearing how it's the golden age for fraud, but really we don't look at it as a golden age for shorts. We know a lot of, with the easy money over the last 5 to 10 years, a lot of these kind of zombie companies have been kept alive, kept going, and it's been hard to short, to be honest with you. We remember going back to 2000, 2010, I mean, long short was all the rage, soft dollars were being thrown left and right. Obviously, it's a different environment right now for short firms, but we are selective in our process, and what we look for are bifurcations between net income and free cash flow. We look for a culture of deception or fraud. Just because a CEO or CFO went to college with some guy and he was kind of fraudulent. I mean, that adds to our thesis, but that's not why we're going to write on a company. Like I said, we're proud of our record during this bull run. You can see our performance there at the bottom. Tudor Perini was our first name we came out with. It was a big hit. We hit our target price of $5 earlier this year. EFI admitted to accounting fraud. They had a bunch of restatements that they needed to do. The CEO needed to step down. Unfortunately, they got acquired. Some of the 3 of our names kind of got acquired and kind of hurt us recently with Cubic, Elliott Management, talking about Elliott again, a rumor to buy them, so that kind of hurt us. But that's part of the business. We understand that's there. But again, we're proud of our record, so we think it speaks for itself. A lot of the names we still have high conviction on, but definitely today with Columbia, we're excited about the name. We have a target price of $45.29, representing 51% downside. Right off the bat, Columbia possesses one of the worst inventory positions in all of retail. Right off the bat, we want our readers to know this right away. We kind of reverse engineered what we believe their inventory balance should be, and we believe it's about 28% less than what they currently have on books. We understand 225 million they're at about 807 million right now. Sounds like a lot, but really when we take a look at all the other retailers and all the other kind of peers in the space, they brought down their inventory by that amount, and Columbia is the only ones kind of bucking the trend, if you will. We believe Columbia's inventory balance is currently stuffed. We believe sell-side analysts who follow Columbia, they have a different view of the company. That's why the stock's been kind of buoyed this year. They think that the retailers are fully leaned out for the fall and will be ready to buy more inventory. While we agree they're lean from an accounting perspective, from a volume perspective, our research shows that they're still pretty much stuffed with inventory. So that's where we think they get it wrong. Columbia came across our screens in around 2019. Red flags are coming from pulling revenue forward and channel stuffing. But at the same time, we think this would be an exciting name if COVID never happened, pre-COVID. I mean, it came across our screens, we were looking at it, and all that COVID did was exacerbate certain red flags at the company. So now we look at it like it's primed to short at these current levels. All right, Under Armour versus Columbia, 2017. So most of Under Armour's issues dated back to 2017. Based on our experience, a lot of these founder-led companies that start small tend to have poor internal controls and accounting as they outgrow themselves. We believe that this is what happened at Under Armour, and that's what's happening here today at Columbia. A main tenet of our thesis revolves around stuffing wholesale partners, so the retailers, with finished goods to increase sales. So when the end of the quarter comes, the Columbia manager sees that they're not going to make sales or numbers for the period, so they call up the retailer to buy more product in the current period if they agree to a discount, essentially stuffing the channel. But managers will hit their numbers, bonuses that way, doing stuff in the channel, even though it's not exactly illegal, but it's nefarious if they keep doing it quarter after quarter. And we can track that through certain receivable metrics, inventory metrics that we like to do. And then, primarily, people incorrectly assume that AR surges are a collection red flag. They are, but more importantly, they signify pulling forward of sales in a stuffed channel. Basically what caused Under Armour's demise dating back to 2017. Our analysis sees exacerbated earnings quality metrics at Columbia, more than we've ever seen at Under Armour. And that's why we're so highly convicted in this name. So, all right, inventory at Columbia, worst of all retail. So yeah, we scoured through pretty much every retail company, every call, everything you can think of. And we believe that Columbia's inventory balance is the worst of all retail. The excerpt on the right was management's first press release regarding COVID. It's interesting because they want the reader to see how small of an impact that the coronavirus was that originated in China. That had on their business. So they were downplaying, this was only going to affect 5% of our sales. So they wanted to reassure investors. But at the bottom there, we can see that they were afraid of supply chain impacts. So what did they do? Based on comments later made by management and the spike in inventory numbers, we believe here is where management panicked and bought as much finished goods as possible. Not really a good idea at the time. Just 2 weeks later, and we remember this time, it hit us kind of quick in the US. I think it was a Utah Jazz Houston Rockets basketball game that got canceled. It was Rudy Gobert, it all happened all at once. But once that happened, I felt, or a lot of us felt that in the US all hell broke loose. But back to Columbia, they put out a press release just 2 weeks later revealing that they would shut down all of their brick and mortar stores, basically leaving them with a glut of inventory on hand with nowhere to go. And we would learn later on that a lot of their retailers would cancel orders, again, leaving them kind of high and dry. All right, so DSI charts, our favorite, day sales of inventory. So with the recent quarter, during the pandemic, obviously it's highly concerning. We see DSI values jump up to 371 days, meaning they have 371 days worth of inventory on their books. But you know what? We saw that the DSI values were on a constant increase even prior to 2020. it's just kind of hidden. It's just kind of hidden because 371 days in the latest period is so high. But if you kind of take a look, we normalized DSI in the latest 2 periods, kind of taking the cost of goods sold value from the prior years to give kind of a normalized balance. And still we can see it's increasing at a heightened rate. So again, while management blames inventory just myopically on COVID, I mean, we can really see that they had problems before this. Their 12-month DSI values on the chart on the right, that was increasing steadily all throughout 2019. Going up from like 120-day balance up to 150, 160, that's large increases. That's basically what happened at Under Armour. And now we see we're coming up to 165 days. And that's a normalized balance. The regular balance is up around 190, or you can see it's reaching up to 200. So all things concerning to us, leading us to believe that the channel is stuffed. And they have to make drastic decisions, whether it's provisioning or bringing down books or things of marking down or things of that nature. Okay, so let me make sure I'm good on time. Columbia versus its peers. Again, the red line there is Columbia. All the rest of the peers are on the right. We can see that, yes, companies were impacted by COVID. But here we can see Columbia well above and beyond anyone else on the books. A lot of the peers actually were able to bring down inventory or bring down their DSI value. If you look at the chart here, not all of them, but a good amount of them were able to. So we believe that 28% of their inventory on hand needs to be provisioned or written off. Again, we know that sounds like a massive number, but when you look at the peers of other retailers, a lot of them did this by provisioning, marking down, and canceling orders. Basically the opposite of what Columbia decided to do. They only took a $6 million inventory obsolescence provision in the last quarter. And for us, this is only scratching the surface. So again, to look at the chart right here, to understand how much inventory Columbia needs to impair to get back down into the 175, 200-day level. Yes, cost of goods sold and sales, when they come back, that will lower it as well. But it's a combination of both. And we showed you the normalized balance before. It's not just, once we go back to cost of goods sold and sales are normalized, then it'll get back to normal. That's not the case at all. Okay. Cool. Moving on. Also, we like to view sales versus, inventory versus future sales. If the sell side was so sure that management would sell through all this excess inventory in fall, we would expect to sell a normalization, or we expect to see a normalization of inventory to forward sales ratio. This is akin to like Apple loading up on iPhones inventory right before a launch. So this may cause current inventory turns or DSI metrics to look bad in the quarter before they release. But when judged against future sales or sell side estimates, these metrics will normalize. So this is not the case with Columbia, as you can see. In fact, these figures on our chart are at a record high, seasonal or so quarterly, or if you look at the 12-month, a record high. So even with the sell side expecting heightened sales, which number one, we think that's not conservative for the fall, inventory metrics still look terrible from an earnings quality standpoint. And again, on our bottom comment right there, retailers delaying a product purchase of inventory will crush Columbia in 2 ways. One, highly diminished sales from retailers as they play a wait and see approach, which we'll talk about later in the pandemic. And Columbia will need to impair millions of inventory that no one will take off their balance sheet. Next, okay, this is an interesting chart to us because when we look at Columbia's gross margin versus their retailers the last 2 quarters, we can see a bifurcation where the retailers had taken accurate provisioning and their stock price took a hit. We believe Columbia's management is trying to maintain gross margins as much as possible. We can see in Q1 how the retailers either took heightened markdowns or provisioned, killed the gross margin. You can see that red box there. But they basically took their medicine from an accounting standpoint, if I want to use that analogy, and rightly so. Columbia, on the other hand, while gross margins contracted somewhat, appears to be trying to maintain gross margin as much as possible. And this is based on management comments as well. We believe that not writing off the appropriate amount of inventory is a form of earnings management or financial engineering. And we believe a lot of their recent stock gains has been because sell side has looked at their gross margin and been happy with, but really it's financial engineering. All right, so we are always cognizant of new excerpts into the 10K. I mean, this is something we always keep a close eye on. It's something written by lawyers and accountants. It's not, so anything new or taken away from it is always a big focus of us. So something happened in 2018 where they were getting pressed by suppliers, and they're pressed by the retailers to, number one, buy inventory earlier in the supply chain process, and two, have more on hand to replenish to the retailers when needed. So this basically puts Colombia into in between a rock and a hard place. And it could work as long as sales are increasing and everyone's happy. But when something happens like 2019, 2020, it blows up in someone's face, and that someone's face is Colombia. And that's why they have such a high balance of inventory. There was this Project Connect they described back in 2018. Again, it was an ill-advised decision to not focus on inventory turns. They were focused on inventory turns before that, and they kind of moved into a new area of trying to appease suppliers and wholesalers. And now that everything has hit the fan, they now want to focus on inventory turns again, which most earnings quality analysts know that when a company focuses back on turns and cash generation, sales and earnings usually take a big hit. And that's something sell-side analysts need to brace themselves for in the upcoming periods. All right, so in our full report, we actually go through, I mean, we've been through so many retailers conference calls, it's unbelievable, but we just put 3 on here now. We could have gone through all the other retailers, but we just wanted to put 3. We didn't think we needed to do more than that, but basically every retailer we looked at is planning this fall very conservatively. We really don't understand where management is coming across that they feel, retailers will be chomping at the bit to buy inventory from them in fall. And not only that, they still have the inventory on their, they took it down from an accounting standpoint, but it's still in their stores. So if you look at Dick's, we acted decisively to reduce, defer, cancel planned receipts. So they canceled receipts from Colombia and others, obviously. For the rest of 2020, we are conservatively planning our inventory receipts. We think it's probably be a tad more promotional because people have inventory to get rid of. So again, it's there from the physical standpoint. It's not, it wasn't taken off their warehouse yet or on their storefront. So it's something, not only Dick's, but it's a theme with all the retailers. So we really are kind of confused with the sell side that believes it's going to be heightened sales for the fall. On top of that, Dick's has been focusing on their homegrown brands, the DSG, Alpine, Kalia, all direct competitors to Columbia. And so every conference call they get, they discuss how their own label brands are outperforming the rest of the store and how they're giving them more floor space at Columbia. All right, receivables. As we can see here, not only are the inventory metrics dreadful, but the AR metrics are as well. So when both inventory/AR metrics are trending the wrong way, as we can see here in our table, this is a harbinger for channel stuffing and pulling forward of sales based on our experience. And our second bullet point there, we can see that in Q3 2019, they had revenue estimates of 883, but Colombia reported revenue of 906, so they beat it. But when you look into what actually happened that quarter, we found a material amount of 45 million in sales were pulled from Q4 into Q3 that management admitted to. And so that was one quarter they admitted that, and they were able to beat sales because of that. But by looking at the accounts receivable metrics, where we take a look at AR versus sales, very similar to the construction company we learned previous to this, we can see if there's pulling forward of sales. So timing shifts like these are eerily similar to the SEC's charges of revenue recognition violations that were presented against Under Armour. The continued rise in AR metrics indicates 2 kind of signals. The company is using relaxed credit terms to entice retailers, which they've admitted to, and shifting future sales in current periods. And now they have a heightened risk of bad debt expenses from failing retailers, which we've noticed that coming too from their heightened bad allowance for doubtful accounts. Now, prepaid expenses. I always bring up prepaid expenses. If I was a CFO and wanted to financially engineer earnings, I would use this account to essentially capitalize all my expenses in any given period. So as an accountant or CFO, it's as easy as debiting prepaid rent versus rent expense in your journal entry. Obviously, that's kind of like a dumbed down version, but you get the picture if we all kind of remember our accounting 101 in here. But you could see our prepaid expenses and other assets relative to OPEX and sales. They took a major jump here. So these are all capitalized expenses coming onto the balance sheet and not hitting the income statement. So again, more red flags, accounting red flags. It's going to be margin compression from this over the next year. All right, Colombia positioned for failure. This quote on the left from the CEO, Timothy Boyle, about the current market environment. I mean, the hubris is just off the charts here. So I think frankly, we're in a great position here. He basically says we have an opportunity where we have inventory present, where we believe that frankly, later in the season, there will be likely a shortage of inventory in the winter products. Many of our competitors canceled all their orders for merchandise coming in from Asia in the winter. So a lot of their competitors did the right thing. Colombia did the wrong thing, went the other way, and now they're trying to justify their actions here. So again, we believe this is going to blow up in their face over the next year. Their X1 launch. Okay, so this is their big new e-commerce platform that's going to revolutionize the company, right? Experience first. That's what it's called. So in H1 2018, they made a decision to launch X1. It's expected to be implemented the first half of 2019. So beautiful. They didn't know, obviously, no one knew a COVID pandemic was going to hit 2 years later, or sorry, yeah, 2 years later from there, but they'll be ready with a new e-commerce platform. So that'd be nice at least. Q4 2018, we're working towards 2019 implementation of C1 and X1. We may shift that to ensure completeness of each system. Okay. Q1 2019, beginning with Europe direct in 2019, followed by a launch in North America in 2020. So again, more delays. Finally, Q1 2020. In North America, we expect to launch prior to the peak 2020 sales period. So they had this huge opportunity to get their e-commerce platform ready before COVID, and they basically, dropped the ball on that 100%. So who knows if they'll get it done through the 2020's pre-holiday season? That's yet to be seen. And another kind of bull case for Colombia is their e-commerce platform that was up 72% year over year. The sell side keeps talking about that. But when we look at it, 72% off a low base is not that much. I mean, when we look at the chart on the right, I know we're going up against Nike and Lulu, but if you look at Lulu in Colombia, they were pretty similar in e-commerce sales going back 2 years ago. And you can see that Colombia just flatlined. And I like to show Nike and Lulu because these are the gold standards in terms of e-commerce sales. In fact, the CEO, Tim Boyle, was on CNBC just about 2 weeks ago. And even there, you get the sense that he's waiting on the reopening of brick and mortar stores to get back to business. He's not, where they bring up e-commerce. This was one of the first quarters they actually gave e-commerce numbers. So again, we don't feel like they are 100% all in on e-commerce. If you look at Nike, they want 50% digital penetration of their digital sales. And you're looking at Colombia, they did 11% in 2019. So we don't think they're there. Colombia web presence dwindles. So take a look. I mean, we always take a close look at Google Trends. It doesn't look like it's improving for Colombia. We've actually looked at this versus Lululemon or Nike, and it's ugly. I mean, they're rising high into current years. Colombia is kind of going straight down here. So finishing up here, this is the App Store. This is the Apple App Store. So we take a look at Nike, almost 1 million ratings, 4.9, 4.8 for Under Armour, Dick's, Adidas, North Face. Let's take a look at Colombia. They have an app that's in Japanese, but not in English. It has 51 ratings, 1.3, and they have an app on fishing, with 4 ratings at 2 that wasn't really working at all. So again, when we look at the numbers here, I mean, how can we expect this company to be really focused on e-commerce? All the sell side kept touting the 72% year-over-year number this latest quarter, but it was off a low base. Their app is pretty much non-existent, and COVID is resurging in the fall here. In the winter. We were going to do like 3-4 slides on the COVID resurgence in the US and Europe, but this was 2 or 3 weeks ago when it was just starting. But obviously with New York, Illinois, California shutting down again, I mean, it's coming back, and this is a new normal, and Colombia is not ready for this new normal. We basically here take a sustainable earnings number that we calculate from, we take down from inventory, pulling revenue forward, and our prepaid expenses. And then we apply the peer group forward PE ratio of 21.5, and that put us to a target price of 45.29 or 50% downside. So last chart, let me just say, we really don't like posting charts. We're more focused on valuations, but we just want to show here that we have Nike and Lulu at the top, and rightly so, but you have Columbia there kind of in the middle for the year, down 7%. This name needs to be down with the rest, kind of this down 58%, 41. The ones at the bottom all took correct inventory provisioning and were legacy, similar to Columbia. But yet, because of their financial engineering, we believe they've been able to buoy their stock price as much as they have. But it will reverse violently over the next year. So that's our presentation. We hope you liked it, and we're ready to answer questions if you like.
Awesome. Thank you so much, Wes. I've been struggling to find out how to share the file with you guys, but we'll figure that out. Anyway, we do have some questions here. First of all, the DSI issue is real, but can't they just take a charge off and move on? COVID would provide the perfect excuse for that.
Well, charging off 225 million is real. I mean, it's a material number, and if it's one thing they can get away with charging off 6 million here, fine, but they have to take that into gross margin as well. They can't one-off that. So every inventory obsolescence needs to be taken down into gross margin. So if they did do that, let's say they did that all in one period, they can't put that below the line as a one-off non-GAAP charge. They would have to put it into gross margin, and that would come down. And yeah, they could try and play it off as much as they can, saying it's a one-off. But for us, I mean, 225 million is a material amount that people will take notice of. So that's kind of our view.
Okay. Another question here is, insiders have been selling. Is there a next generation in the business? What is the FCF free cash flow impact of the inventory normalization?
So is it about the insider selling, or what's the question specifically?
Well, we can take one at a time. So I guess, like, yeah, I mean, what is the next generation in the business? Like, what is I assume that refers to the future products and how they plan to, generate growth in the future.
Well, they basically stopped everything, all the plans, the C1 plan, Project Connect, everything. The only thing they've been focusing on this last year, because of COVID, is the X1 e-commerce release, and they still can't get that right. So for us, we don't see a scenario where you had 8 months where everyone was sitting at home doing nothing, and they came to your non-existent app. They came to your website, which is legacy, 3 or 4 or 5 years old, that doesn't compare to all these, the rest of the peers. And then all of a sudden, let's say they do get it fixed by the holiday season, they're going to come back and be, I mean, they had all this time to see your website, which should have been there done already. And they basically dropped the ball on it. So we don't really see, and again, the rest of the projects put on hold. They're not really working on anything. And this is the first time too, they talked about inventory carrying over for not different seasons, but years. We've never seen them say that before in a conference call. They say they'll carry over to the next season or, a couple months, but this is the first time in the last conference call they talked about carrying over inventory for years, which is never a good sign in terms of aging. So yeah.
I guess I'm sorry, the insiders, he means shareholders.
We do keep track of that. I don't have those numbers in front of me right now, but again, that's not really our forte, but we obviously keep a close eye on insider selling as well. Obviously, with heightened insider selling, we keep a close eye on, but the 10b5-1 plans can always kind of put a wrench in things. But again, I don't have those numbers in front of me right now, so I can answer that.
All right. Another question here is, how long do you think Colombia can maintain the story that inventories are fine? By Q1 2021, they should be forced to show what you believe to be true, right?
Yeah, I think in the next 2 periods. I mean, maybe they can play the game one more quarter, next week they report, but we definitely think within the next 2 to 3 periods, heighten, either decrease sales, heighten write-offs, heighten provisioning, bad debt expense, all that is gonna face them over the next 2-3 periods.
Cool. Okay. Let me see here if there are any other questions. I don't see any. We are running a tiny bit behind schedule, so let's just move on.